This is part 2 of the presentation of Module 1 of Accounting 311, Financial Statement and Analysis for Global Entrepreneurs. To fully understand a company, we must first understand the business environment that the company operates in. There are various ways to assess the business environment. We will study 3 frameworks that are commonly used to analyze the business environment: Porter's value chain model, Porter's 5 forces, and Swot model. Porter's value chain model is one way that analysts may assess the business environment. As the diagram shows, the value chain model seeks to identify and understand the activities that create a company's profit margin. The primary activities shown at the bottom are the inbound logistics, operations, outbound logistics, marketing and sales, and servicing. The support activities shown at the top include the firm infrastructure, human resources management, technology and product development, and procurement. The results of these activities manifest in a company's financial statements and other reports on performance and financial condition. This value chain analysis can be used to interpret those reports. A company's primary and support activities are not carried out in isolation, but are instead influenced by 5 important forces that confront the company and determine the competitive intensity. This diagram illustrates the forces of industry competition, buyer power, supplier power, product substitutes, and threat of entry. The 5 forces include the competition and rivalry of the industry that raises the cost of doing business, as companies must hire and train competitive workers, advertise products, research and develop products, and engage in other related activities. The bargaining power of buyers can extract price concessions and demand a higher level of service and delayed payment terms. This force reduces both profits from sales and the operating cash flows to sellers. The supplier with strong bargaining power can demand higher prices and earlier payments, yielding adverse effects on profits and cash flows to buyers. As the number of product substitutes increases, sellers have less power to raise prices and/or pass on costs to buyers. Accordingly, threat of substitution places a downward pressure on profits of sellers. New market entrants increase competition. To mitigate that threat, companies expend money on activities such as new technologies, promotion, and human development to erect barriers to entry and to create economies of scale. Another method to analyze the business environment is SWOT analysis. SWOT is an acronym that stands for strengths, weaknesses, opportunities, and threats. There are 2 parts to SWOT analysis. First, there needs to be an internal analysis that identifies the company's strengths and weaknesses, while for external purposes you review the opportunities and threats to the company. SWOT analysis tries to understand particular strengths and weaknesses that give rise to specific opportunities to exploit the strengths and threats caused by weaknesses. When used as part of an overall strategic analysis, SWOT can provide a good review of strategic options. However, SWOT is sometimes criticized as being subjective. 2 individuals can identify entirely different factors from a SWOT analysis of the same company. This is partly because SWOT is intuitive and allows varying opinions on the relevant factors. When analyzing the competitive advantages of the company, it's important to identify sustainable operating income and cash flow. In analyzing competitive advantage, we must first identify what factors explain it and then whether that advantage is sustainable. Also, does management have a plan to develop a sustainable competitive advantage that can be implemented in an acceptable period of time and with a reasonable amount of investment? Answers to these questions impact forecast of the company's future performance. The factors that impact a company's competitive advantage include barriers to entry such as patents and other protections of intellectual property. These barriers allow a company to achieve a competitive advantage and charge higher prices for their products or services and thereby earn excess returns. These legal barriers typically have a finite life, however, and a company must maintain a pipeline of innovation to replace intellectual property that loses patent protection. Product differentiation allows a company to earn excess returns. Typically, differentiation is achieved from technological innovation that produces products and services with attributes valued by customers, not easily replicated by competitors. Another approach to achieving excess returns is to become a cost leader. Cost leadership can result from a number of factors, including access to low-cost raw materials or labor while maintaining quality, manufacturing or service efficiency in the form of cost-efficient processes, and manufacturing scale efficiencies, greater bargaining power with suppliers, or sophisticated IT systems that permit timely collection of key information. In absence of a competitive advantage, the analysis focuses on the likelihood that a company develops such an advantage. Management often discusses strategy with stockholders and equity analysts that are recorded in conference calls that are readily available and reported in the financial press. Creating a competitive advantage that yields excess returns is difficult, and we are wary of forecasted excess returns for an extended period. Therefore, we must test the sustainability and validity of the drivers. In this learning objective, we will cover basic financial profitability analysis. Some people mistakenly assume that financial accounting is an exact discipline and that companies select the one proper accounting method to account for a transaction and then follow the rules. However, this is not the case because GAAP allows companies choices in preparing financial statements. The choice of methods can yield financial statements that are markedly different from one another in terms of reported income, assets, liabilities, and equity accounts. Historically, the FASB has promulgated standards that were quite complicated and replete with guidelines. But in recent years, the pendulum has swung away from such rigidity. Now management is required to step back from the details and make a judgment on whether the statements taken as a whole fairly present the financial condition of the company as asserted in the company's audit report. Moreover, since the enactment of Sarbanes-Oxley in 2002, the SEC requires the Chief Executive Officer and the Chief Financial Officer to personally sign a statement attesting to the accuracy and completeness of the financial statements. Knowing that a company reports a profit is positive as it indicates that customers value the company's goods or services and its revenues exceed expenses. However, we cannot assess how well a company is performing without considering the context. The important point is that a company's profitability must be assessed with respect to the size of its investment. This is done with a common metric, return on assets, defined as net income for the period divided by the average total assets during that period. We can further isolate the components that are driving return on assets by separating the ROA into the profitability that relates profits to sales, the profit margin, and reflects the net income after tax earned on each sales dollar. The second component is called asset turnover and reflects sales generated by each dollar of assets. Management wants to earn as much profit as possible from sales and maximize asset productivity to achieve the highest sales volume for a given level of assets. There are an infinite number of combinations of profit margin and asset turnover that yield the same return on assets. The graph on this slide shows actual combinations of these components for companies that are highlighted in the text. The graph's green line represents possible combinations of margin and turnover to yield the 7.7% median ROA for the company's graph. The 7.7% ROA is higher than the 5.7% median ROA for all the Standard & Poor's 500 companies for this same year. Technology companies such as Intel and Cisco typically have high margins but low turnover because the company's substantial assets include mostly marketable securities or intangible assets. There are also low margin and high turnover companies like Nordstrom and Target. These companies find it difficult to differentiate their products, and the open competition tends to keep prices down, which yield lower profit margins. These companies must focus on turnover to maintain acceptable ROA. The return on assets is the product of profit margin and asset turnover. Companies that have high ROA include Intel, Apple, Colgate-Palmolive, Starbucks, and Home Depot. To have high ROA, companies must have both high profit margins and asset turnover. Managing one but not the other is not sufficient. Another important analysis measure is return on equity, which is defined as net income divided by average stockholders' equity, where average equity is commonly defined as beginning of year equity plus ending year equity divided by 2. In this case, company earnings are compared to the level of stockholder investment. ROE reflects the return to stockholders, which is different from the return for the entire company, ROA. Forecasting financial statements is a step where we proceed from our understanding of the company's current environment in step 1 and what has occurred with the company in step 2 to a prediction of what will occur next. This step is crucial to decision making and valuation and is arguably a very difficult task. When we formalize predictions and state them in the form of financial projections, the quality of our forecast is dependent on at least 2 factors. First, the quality of our analysis performed in steps 1 and 2 in understanding the business environment and in adjusting and assessing financial information is crucial. If we fail to effectively understand the context in which a company operates, we will not be able to make appropriate estimates going forward. The quality of our adjustments made to the company's financial information drives the quality of forecast. Second, the quality of our forecast is dependent on our assumptions being realistic and achievable. For example, is a company which has recently experienced sales declines likely to become the industry leader? Probably not. Can a company increase sales when confronting a new entrant in the industry? Doubtful. In sum, the importance of forecast quality cannot be overemphasized, as it is vital to our estimate of where a company is going, which are direct inputs to valuation. The forecasting process estimates future income statement, balance sheet, and statements of cash flows in that order. The reason for this ordering is that each statement uses information from the preceding statements. For example, we update retained earnings on the balance sheet to reflect our forecast of the company's net income, and the forecasted income statement and balance sheet are used in preparing forecasts for the statement of cash flows. When we embark on financial statement analysis, we are motivated by the need to make a financial decision. This could be from an external standpoint as to whether to buy or sell shares as an investor or to lend or extend credit to the company. The financial decision could also be from an internal standpoint, such as evaluating a potential acquisition or change in scope of operations. All financial decisions involve valuation at some level. As stated previously, all financial decisions involve valuation. In making these decisions, we attempt to predict the future. The key to good valuation estimates is accurate forecasts of future cash flows. And the key to forecasting is having a good understanding of where the firm currently is and the business environment in which it operates. While there are many valuation models currently in use by financial analysts, investors, and lenders, models fall roughly into 2 camps: those that use fundamental firm-specific data and those that rely on market multiples. There are situations where the current value of expected payoffs, such as cash, earnings, or dividends, can work best for valuation purposes. In others, the market method, which uses market multiples estimated from the data of comparable firms, is preferable. There is a natural positive relationship between expected earnings and stock prices because stockholders expect dividends, which are paid out of earnings. Rigorous financial statement analysis seeks to uncover a company's persistent core operating earnings and cash flows, revealing the underlying economic and company-specific factors that drive profit margins and productivity ratios. Once we understand the underlying dynamics of the business, we are better able to forecast its future earnings and cash flows. Financial markets also use forecasts to price a company's debt and to determine interest rates. Credit ratings are determined by a number of financial ratios based on balance sheet, income statement, and cash flow information. The ratios will determine the company's credit rating, as shown on this slide. As the ratios become progressively weaker, the chance of default increases and the credit rating assigned will be lower to indicate the increased risk associated with the debt. Some question the value of financial statement analysis and business valuation if capital markets are truly efficient. The idea of market efficiency is that security prices reflect available information and respond rapidly to new information when it is available. Some people incorrectly believe that this implies that there is no gain to engaging in independent financial statement analysis and firm valuation. However, if our expectations differ from those of other investors, there exists an opportunity to trade. Market efficiency is predicated on the effect of many individuals, investors, and analysts who gather information, interpret it, and then engage in trades based on their analysis. These trades create supply or demand pressure such that market prices adjust to a new equilibrium. The task of information gathering and processing is the task of financial analysts and investors. Capital markets function well in the U.S., particularly for the largest firms, because of self-interested buy-side and sell-side analysts, institutional investors, and others. Another facet involved in market efficiency relates to management incentives. Management often has an incentive to report favorable financial information due to a desire to maximize share price for compensation contracts or other reasons. While U.S. GAAP and IFRS put some restrictions on what is reported, the financial data potentially can be biased or misleading. Our analysis attempts to recognize and adjust for such possibilities. However, our estimates of value are only as good as the accounting numbers that underlie them. As we discussed, the United States is among only a few economically developed countries that do not use IFRS. While laws and enforcement mechanisms vary across countries, the demand and supply of accounting information are governed by global economic forces. Thus, it is not surprising that IFRS and U.S. GAAP both prescribe the same set of financial statements. As noted previously, all publicly traded companies are required to file various reports with the SEC, two of which are the 10Q quarterly financial statements and the 10K annual financial statements. The SEC website provides access to electronic filings. To find the reports for a company, you can either enter the company's name or stock symbol and then click search. This slide shows how this would be done for Apple. Next, you would enter the form number you are interested in under filing type, such as 10K as shown on this slide. A list of the 10Ks for various periods would then be returned and you would click on the filing date for the period you are interested in. In this case, we click on 2008-11-05, which is approximately 5 weeks after the end of Apple's fiscal year end of September 28, 2018. Exhibits relating to Apple's 10K filing appear and we click on the 10K document. The 10K would then be shown. An alternative is to download an Excel file of the financial statement data. From the earlier search results page, you would click on Interactive Data. You can click then on View an Excel document to view or download the financial statements or notes. Data analytics is an umbrella term for a diverse set of activities related to gathering, organizing, and analyzing raw data. Fueled by advances in computer power, mass storage, and machine learning, data analytics applications have skyrocketed in the past decade. Companies use four types of data analytics. Descriptive analytics summarize data and describe observable patterns. These analyses focus on understanding what has happened over a period of time. Diagnostic analytics seek to understand what happened and why. This involves more diverse data inputs and a deeper dive into the data. A hands-on hypothesis often guides the direction for a diagnostic analysis. Predictive analytics enable an understanding of what is likely to happen or what will happen if something else happens. Sales forecasts depend on predictive analytics, as do equity valuation models that financial analysts use. Last, prescriptive analytics address the question of what should be done and suggest next steps or complete courses of action. A classic example of prescriptive analytics is the Waze navigation app that analyzes traffic and road data and recommends the best driving route. Data visualizations are the graphical display of numbers with charts, figures, and bars, and is often a very effective way to convey meaning and trends vis-a-vis data arrays. This is especially true for big data sets that can be so complex that visualization is a necessary first step for analyzing raw data. Companies and analysts use data visualizations for descriptive and diagnostic data analytics and to prepare reports that inform business decisions. A wide range of data visualization software packages is available. These packages can accommodate structured and unstructured data and are user-friendly and most have a drop and drag user interface. A powerful feature of these data visualization tools is the dashboard that simultaneously displays a number of charts and graphics to capture key insights in one view. In your textbook, you will find visualizations of competitive metrics, industry benchmarks, or time trends for critical accounting numbers. Graphics help us to convey information in a more easily accessible way. Data analytics can provide information for making well-informed data-driven decisions. Understanding relevant data at a deeper level can give a firm a competitive advantage and help business leaders better meet their goals. Data analytics is especially relevant to financial statement analysis because there exist many large structured data sets of financial statement data, including the SEC's XRBL data, which stands for Extensible Business Reporting Language, a freely available and global framework for exchanging business information. And this is the end of part 2 of the presentation for Module 1.